we will have our AI do all the walking and working and talking for us, up to a point, right? Because of agentic AI. And we need smart contracts because these agentic AI, our AI agents or assistants are going to be interacting with sites, maybe like CoinDesk, that, where we'll need to pay some money for something, one thing or another. And these are going to be automated smart contracts. Well, agentic AI is going to make that happen. So this is the convergence of AI and blockchain technology. But before that, what we're also seeing is a revolution in financial services. Thanks to the green light from regulators, more financial services companies are moving into the blockchain world.
We're at a tech tipping point. AI is evolving into agentic systems that can act, decide, and transact for us, while blockchain has become the secure backbone for automated digital interactions. Together, these forces are starting to collide, and that collision will reshape finance, commerce, and the internet itself. Cathie Wood argues that agentic AI will plug into blockchains through smart contracts, creating an automated economy where AI agents negotiate, buy, and settle in real time without intermediaries. Ethereum, she says, is uniquely positioned to be the institutional protocol for that decentralized future, powering tokenization, autonomous systems, and new business models. Wood also expects macro conditions to improve, recessionary pressure easing, inflation falling, and productivity gains from AI, robotics, and energy tech driving deflationary forces. In this environment, Bitcoin and Ethereum both stand to benefit, and innovation could accelerate faster than most expect. Stay tuned, the next phase of technological and financial change may arrive sooner than you think.
We have been saying for quite some time that the economy has been in a rolling recession. When the Fed jacked rates up 22-fold in little more than a year's time, one sector after another began to give way, starting with housing. Housing, by many measures, is down 35% still from the peak. And we're seeing some metrics take another step function down. So I think that has some people concerned. I think the housing inflation numbers are going to come down. They're already, the monthly numbers that we get from various sources are showing declines. Year over year, they're not declining, except for maybe median existing home sales. But we do think that one of the solutions to the affordability crisis, if sellers really want their homes to move, they're going to cut their prices. And because that is if interest rates don't come down. And if they do cut prices, then the big surprise in the latter part of this year is how low inflation is going to go. And there's a big lag between the time home prices fall and they get into the statistics and leave the statistics as well. So this is going to be with us for quite some time. So I think we've been saying we believe that thanks to certainty now, more certainty about tariffs, tax policy, government spending, and regulation or deregulation, that we're getting ready to move from this rolling recession into a much stronger than expected recovery. In the next, I'll say 6 to 9 months, it will become obvious. With productivity, one of the biggest surprises, it's already strong given the slow growth rates in the economy. I think year over year, it's still up above 2%. But we think it's going much higher thanks to all of the technologies around which we have centered our research. So robotics, energy storage, AI, very importantly, blockchain technology, obviously important here, and what we call multi-omic sequencing in the life science space. All of those innovations are incredibly deflationary. And the best example probably is AI. AI training costs are dropping 75% per year. AI inference costs, so the cost to get an answer for as we're typing into ChatGPT or Grok, my preferred right now is Grok, Those costs are dropping anywhere from 85 to, in China, we've gotten a statistic, 98% per year. So when you cut the cost of something, you get a lot more of it. So we think this is good deflation. This is not deflation like 08, 09. That was very bad deflation. This is good deflation for those companies that are on the forefront of these new technologies. It might be bad deflation for companies that are going to be disrupted. And if they're being disrupted, they'll be forced into cutting prices as well. So we think we're going into a much more deflationary world than I think many economists and strategists would suggest.
Talk to me about that 6 to 9 month outlook. Where does crypto fall into your vision for a stronger next 6 to 9 months?
The regulatory environment is very important here. We've gone from a hostile regulatory regime under Gensler at the SEC to a very, very friendly regime now, with legislation guiding regulators instead of regulation through enforcement, which was forcing innovation off U.S. shores to other countries. And now that's changing aggressively, especially appointing David Sachs, the czar for both crypto and AI. And this concept of agentic AI coming into view, where we will have our AI do all the walking and working and talking for us, up to a point, right? Because of agentic AI. And we need smart contracts.
Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
Because these agentic AI agents or assistants are going to be interacting with sites, maybe like CoinDesk, that, where we'll need to pay some money for something, one thing or another. And these are going to be automated smart contracts. Well, agentic AI is going to make that happen. So this is the convergence of AI and blockchain technology. But before that, what we're also seeing is a revolution in financial services. Thanks to the green light from regulators, more financial services companies are moving into the blockchain world because they realize it's much lower costs. So as I explain to our clients what's going on here, I like to back up because I remember this time very well. In the early 90s, late 80s, early 90s, when developers were first working on the internet, there was no idea that financial services or commerce would take place on the internet. And therefore, there was no payments layer. Now, thanks to blockchain technology, we have the payments layer. Over the last 30, 40 years, because we didn't have the payments layer, we needed to, and because financial services and commerce did migrate onto the internet in a very big way, the traditional world had to mitigate the risk of putting credit cards online and, trying to use traditional financial tools in this internet world. And all of the intermediaries involved have been taking anywhere from 2 to 3.5% out of each transaction, paid for mitigating the risk. We can probably drop that And that's a tax on the system, right? We can drop that tax from 3.5%. These are US numbers. In Nigeria, the numbers would be 20% or more, right? Drop that tax from 3.5% to maybe 1%. And, the financial services world is huge. We think it's going to be a $250 trillion assets under management world in 5 years. So if you're talking about those kinds of numbers, taking 2 to 2.5% out of, or lowering the tax by 2 to 2.5%, will lower the friction in the market and increase the efficiency.
Cathie Wood says the next economic cycle will be driven by innovation, not just short rebounds. With inflation easing and productivity rising, she sees AI, blockchain, and energy storage as the real engines of growth, supported by lower costs and better regulation. She also points to Ethereum as the key settlement layer for an AI-driven, autonomous economy. With Coinbase and Robinhood building on its Layer 2 ecosystem, Ethereum's decentralization and security could make it the institutional backbone of the decentralized future.
Do you see Ethereum as being the foundational layer to enabling a productive agentic AI world?
Yes, we have been watching carefully who is signing on to what protocol as they begin to develop their digital asset strategies. So, well, first we saw Coinbase, for its Layer 2 base, chose Ethereum. More recently, we saw Robinhood, for the Layer 2 that it is evolving, also building on top of Ethereum. We had a thesis that Ethereum was going to be the institutional protocol. I know that Solana was doing much better. Solana had a massive run relative to Ether. And so many people were challenging that notion, and yet we're seeing the votes being placed. And it makes sense. Ethereum, while it might be higher cost and a little slower, it's more decentralized and therefore more secure. Solana, we think, is probably going to be the winner in more consumer-facing applications. And it was very, very difficult for us to gain a position in our ETFs with good exposure to Ether. There are all kinds of problems when 40 Act funds buy another fund, another ETF to gain exposure. There are tax issues. There are fee issues, fees upon fee issues. There's something called, and this is a tax issue, bad income. If the profits associated with something generating bad income, bad doesn't mean evil at all. It just means it's a tax term. If those profits, gross profits, this is gross, there's no netting here. If those gross profits are more than 10% of the total profits generated in a year of a fund, the entire fund can be shut down. The tax benefit, you'll basically you'll lose a lot of tax benefits, and you'll be subjecting the fund to a great number of fines, if not actual shutting down. So we can't take those risks. And as you can tell, I'm not deep into tax law, and I'm not going to be able to explain exactly who, what, when, where, why, and how. I just listen to our trading team, our compliance team, our finance team, and I say, okay, I can't go there. It's just, I can't do it. So this is the first time we've been able to gain a solid position in Ether. And, sure, it comes at a premium, but what's different from Bitcoin treasuries, like MicroStrategy, now Strategy, is there's just more utility that these Ether treasuries can offer, staking being one of the most important ones. The ETFs, at least not yet, the Ether ETFs are not allowed to stake. Mm-hmm. So, and yes, I think as you know, we were the cornerstone investor in Circle. So we've been watching the stablecoin movement, which is exploding. And of course, again, most of that is happening on Ethereum. So when people ask me what is the biggest surprise in the last 10 years, so we started ARC in 2014. We wrote our first Bitcoin blog back then. 2015, we wrote our first white paper on Bitcoin. And we thought that Bitcoin in emerging markets would serve the role that stablecoins now are serving. And Tether is just an unbelievable story that way. I just learned from one of the founders of Tether, Paolo, that they had no idea that Tether would become an important source of dollar exposure to emerging markets until COVID, when the children of in families in emerging markets would go to their parents and say, you don't have to go into the black market today to buy dollars. We can do this on the internet. And that's how it really spread, which is fascinating, isn't it? We thought Bitcoin would serve that role because we didn't know about stablecoins. And even very recently, I think we're becoming very surprised at how quickly the uptake of stablecoins is. So if we had to modify anything in that $1.5 million forecast, you'd probably see and you can see on a table in Big Ideas 2025 how we build up the bull case. We'd probably take a little bit from the emerging market part of that stack, but I think the much bigger force right now is it's the gateway into digital assets for institutional. It's a new asset class that and the really substitute for gold as a store of value. Another use case. Those are the two biggest, and those we have not changed at all our opinion on. So I think we can safely say that our bull case is well over $1 million in 5 years.
Cathie Wood's conviction in Bitcoin, Ethereum, and Solana highlights her belief that these assets form the backbone of institutional adoption and decentralized finance. Meanwhile, Raoul emphasizes the massive upside potential of emerging tokens like SUI, showing that the crypto market is not just about core infrastructure but also about capturing explosive growth opportunities in new layers of innovation. Together, their perspectives paint a picture of a multidimensional crypto landscape, where stability and scalability meet bold experimentation and outsized gains. For investors, this means understanding both the foundational assets and the newer, faster-moving projects shaping the future of finance and technology. Do you think Ethereum will remain the leading platform for institutional adoption, or could another chain take its place? Are you more focused on holding core assets like Bitcoin and Ethereum, or exploring high-upside altcoins like SUI? Let me know in the comments.